Welcome to EKO201E Economics. I'm Chris Hannum. This is lecture 18 on savings, investment, and the financial system. In the previous lecture, we talked about the idea that there's a connection between savings and investment, just in the sense that if we want to invest to increase the amount of physical capital that exists in the economy, to make our economy grow, to make workers more productive, that money for investment needs to come from somewhere. It can't very well be consumed and used to buy televisions and things for households. Those households must save it instead. And then that saving, we said, somehow became investment. What we'll be talking about in this lecture is how exactly that takes place and what factors influence those decisions to save and decisions to invest. When we talk about the financial system, what we're talking about here is a group of many different types of institutions, each of which plays a different role in matching up those who save and those who might want to invest. So we said that somehow savings becomes investment, and that means somehow people who save have to be matched up with other people or other businesses who would like to invest. And the financial system is the system through which that is arranged. So it's a group of institutions that play some kind of a role. These are a variety of institutions like banks, insurance companies, exchanges, that play some kind of a role in helping to match savers and potential investors or borrowers. A financial market is some kind of a market in which those people interact. The market is where those potential savers, those potential borrowers, therefore investors, because we imagine that investors will borrow saving in order to invest it, can engage in these transactions. One example would be a stock market. That's an example of a financial market where a particular financial product, a stock, which represents a share of ownership in a company, or a share of ownership of the capital that that company owns, is bought and sold. Another example would be a bond market. A bond is not a share of ownership of anything. A bond is a debt. So it's a certificate which can be traded, it can be bought and sold, which says that the person who has borrowed the money, who is indebted, must pay whoever holds the bond. So in the bond market, someone who holds a bond, who has lent money to someone already, can sell that bond to someone else, who will then become the holder of that bond. Some types of financial institutions play a role in the financial system we could classify as intermediary. They act as financial intermediaries. So it's not a financial market where somehow lenders and borrowers meet up. Now, if an institution is a financial intermediary, they simply help bring together the borrower and the saver. So to bring together the saving and the investment parts of our economy. But they don't directly engage necessarily in these transactions, or don't facilitate the direct transaction occurring as a bond market would. And the classical example of a financial intermediary is a bank, whereby savers can interact with the bank by putting their money in the bank in exchange for a rate of return. And then the bank can also interact with borrowers who might borrow that money for an even higher interest rate, or investors who might need to borrow that money at the high interest rate. It's not necessary if each individual, both the borrower and the saver, the investor and the saver, interact with the bank, it's not necessary for them ever to interact with each other or know who the other party is. One important role that these banks may play is first that if an individual wants to save and earn some return, they might be worried about lending all of their money to one business who would like to make an investment, because what if that business fails? That's an awful lot of risk if all of the money that they've saved is loaned out to a single business. On the other hand, what a bank can do, the bank can take the savings of 1 million people and they can loan those out to 1,000 businesses. each of those people has not lent their money to a single business, which might fail, but has lent some of their money to each of those 1,000 businesses. So the risk to the individual, the risk to the bank as a whole, is much less because of diversification. Now, the other important role that this may play, remember, it isn't simply that banks are taking some of the potential returns from saving and keeping it for themselves, although they are doing that. Part of what banks are doing is taking many savers' savings and lending it out to one business, or 2 or 3 or 4 businesses, so that none of those individuals, even if they wanted to lend the money to that one business, would have had enough money to meet that business's investment needs. Now, banks aren't the only kind of financial intermediary we'd be concerned with in our broader economy. They can help to match up savers and investors. We would also consider mutual funds to be an example of a financial intermediary, matching up those who would like to borrow, those who would like access to financial capital, being businesses issuing bonds, governments issuing bonds, governments issuing other types of treasury certificates, and businesses issuing stock. They could match those up through the mutual fund with individuals who would like to save. And these individuals save by buying shares in the mutual fund, which entitle them to shares of everything that the mutual fund itself owns. And then it's the mutual fund that interacts with those businesses who would like access to financial capital. They sell those shares of stock they've issued to the mutual fund. They sell those bonds that they've issued to the mutual fund, and never need to interact directly with the individuals who would like to save. So note, we can classify the saving that occurs in our economy, whatever kind of institution it goes through. We can classify the saving as being one of 2 types, either private saving or public saving. Private saving is the saving that individuals in our economy that might otherwise consume, households in our economy, choose not to consume and to save instead. It's their income, or Y, minus the taxes that they pay, since they obviously can't save money they've paid out in taxes, minus their consumption expenditures. So here, the private saving in our economy is equal to Y minus T minus C. So whatever's left over from income that isn't either paid for consumption or taxes. Next, public saving is saving by the government. And public saving, remember, is often negative. That's public borrowing. Public saving is the tax revenues that the government receives minus government spending. Here we're only concerned with government spending on goods and services, not on government transfers of income. I'm talking about the G that is used for calculation of GDP. So public saving is T minus G. Then the sum of all saving in our entire economy, that should be both private saving and public saving. So total saving would be Y minus T minus C plus T minus G. So total saving in our entire economy, therefore, when these T's cancel out, because T adds to public saving, but it subtracts from private saving, would be Y minus C minus G. So if national saving, total saving in our nation is then Y minus C minus G, that should look like something to you already. So recall that national income accounting identity. That's what we use to calculate GDP. This wasn't to say that as C goes up, GDP goes up. This is how we calculate GDP. We calculate C, we calculate I, we calculate G, etc. And it gives us our estimate of GDP. By definition, these have to be equal. Now, our GDP calculation was that Y equals C plus I plus G plus NX. So then in our GDP accounting identity, suppose we take Y and we subtract C, and then we subtract G. We'd get Y minus C minus G by subtracting C and G from both sides has to equal I plus NX. So our national saving has to equal I plus NX. Well, if we suppose, hypothetically, that our nation is closed or our nation engages in balanced trade, whichever, so NX is 0, then that would give us the result that I had to be equal to Y minus C minus G. So I had to be equal to national saving. All that means is, if we don't have any financial capital coming in from other countries to enable us to invest without saving, the only way we'll be able to invest is if we save that money ourselves. The total amount of financial capital available through savings all eventually becomes some form of investment. Now, before you ask, what about saving that isn't invested? Now, suppose you save the money in the bank, but nobody uses that for investment. Instead, somebody borrows that money through credit card spending, and they bought a television, and they bought some expensive restaurant meals. Obviously, that's not investment. That is your saving, but it isn't part of national saving. It's not part of private saving either, because you have a positive saving, but somebody else who's borrowing this money on their credit card to buy televisions and restaurant meals, they have negative saving. Those two cancel out. They make no contribution to national saving. They're not what we're concerned with. When we look at the government specifically, we look at that public saving portion of total national saving. We could say that for scenarios where the government has positive saving, so tax revenue is greater than G, T is greater than G, T minus G is greater than 0, we say the government has a budget surplus. Unfortunately, for most governments around the world, governments do not have surpluses. They do not save, they borrow. And governments that do not save but rather borrow have a small t and a large G. Spending is greater than revenues. We say that these governments have budget deficits. Note, when the government has a budget surplus, all else equal, this means national saving will be higher. So investment could also be higher. If the government has a budget deficit, this means all else equal, national saving is going to be lower. So investment would need also to be lower, unless that investment were to come from foreign countries and incorporated in, we'll talk about next, net exports. For one example you can try to work through, a worked example of GDP, public saving and private saving. Suppose GDP in the country is 10 trillion US dollars. This is supposed to match something like the real US economy. Suppose consumption, the C in that identity, is 6.5 trillion. The government spending, the G in that identity, is 2 trillion. But the government has a budget deficit of 300 billion. Now try to find what in this particular scenario public saving would be, what taxes must be to give that budget deficit, what private saving would be, what national saving would be, and then what investment must be. Well, first to note here, if we said that the government has a budget deficit of 0.3 trillion, 300 million, that budget deficit is a negative public saving. That negative public saving is negative 0.3 trillion or 300 million. Now, if the government is spending 2 trillion and they have a deficit of 0.3 trillion, so G minus T is 0.3 trillion. The government must have revenues of 1.7 trillion. It must be the case. Tax revenues are 1.7 trillion. So now, how much money do consumers have available, have left over for them to save? What would private saving be? Well, Y, all that income, must be 10 trillion. They're consuming 6.5 trillion and also paying 1.7 trillion in tax. So we subtract that T and we subtract that C from their income Y of 10, and we get these households must have a private saving of $1.8 trillion. What's national saving then if private saving is $1.8 trillion? Well, national saving includes the private saving of 1.8. It also includes the public saving of negative 0.3, of negative 300 million. So total saving, national saving, must be 1.5 trillion. Now here we don't make any assumptions about net exports or foreign direct investment, so we ignore that possibility that the United States might be able to invest without saving, and hold that identity true that for the country to save, they must invest the same amount. For them to invest, they must have saved that same amount. If we determine that national saving is 1.5 trillion, so the United States must be also investing 1.5 trillion. Next, suppose hypothetically in this scenario that the United States considers trying to stimulate the economy by using a tax cut of 200 billion. Now, if they have a tax cut of 200 billion, that's 0.2 trillion, that will reduce T by 0.2, or by 200 billion. So T was 1.7 before, it will become 1.5. We want to look at what happens to private saving, what happens to consumption, national saving, investment, under two different scenarios. The first scenario assumes, as certain economists based on their theoretical models believe, that this sudden tax cut, this sudden windfall gain that people didn't expect, is all saved. Why might people do that? Well, some economists imagine that any money you receive that you didn't expect didn't factor into any of your long-run plans. And to the extent that you want to have a stable consumption path over many years, you would choose, instead of consuming all of that right now, to consume a little now and a little at every year for the rest of your life. Any of these unexpected windfall gains. Now, if that happens, and consumers save all of that gain, what happens to private saving? What happens to public saving? What happens to investment? Well, if consumers save all of that tax cut, then the result is that consumption does not change, even though consumers are paying less in tax. So if consumers are paying less in tax, have the same consumption, private saving does rise, and it rises by exactly the same amount as the tax cut. Here, private saving goes from 1.8 to 2. But public saving, which was previously negative 0.3, falls by a further 0.2 to negative 0.5. Previously, the government had 1.7 trillion in tax revenues with 2 trillion in expenditures. Now they have 1.5 trillion in tax revenues with 2 trillion in tax expenditures. Now here, total national saving, the combination of private and public saving, goes up by 200 billion and then down by 200 billion, and in the end, it doesn't change at all. So we have no change in consumption, we have no change in national saving, and we have no change in investment. Now, if the government is trying to stimulate the economy in the short run through this kind of a tax cut, often what they want to do is to increase consumption, not to increase saving. To increase consumption in the short run, when due to some kind of a recession, it might be temporarily low. So in the second case, suppose consumers save some of this 200 billion, but they only save 1/4 of it. And the remaining 3/4 of it they spend. Now in that case, there's no change in the effect that we expect this to have on public saving. Tax revenues go down to 1.5 trillion, government expenditures stay the same, so public saving drops by 0.2 to negative 0.5 trillion. Now, for consumers, for households, their consumption increases by 150 billion. It increases from 6.5 trillion to 6.65 trillion, because we said they save only 1/4 of the 200 billion, and 3/4 of it they consume. In this case, their saving increases, but it increases by only 50 billion. Now, in this scenario, while public saving decreases by 200 billion and private saving increases by only 50 billion, the net effect on total saving for the nation is a reduction of 150 billion. So total saving falls by 150 billion, consumption rises by 150 billion, investment would fall. If there's no ability for the country to bring in additional money, investment would also fall by 150 billion. I mentioned back in the first lectures for this course that in economics we use a lot of jargon. We use a lot of terminology where these terms sound like the ordinary words that people use in other contexts, but in economics, they mean something very specific. And saving and investment in economics means something just a little bit different, but something specific that you should know. Something specific to economics. When we say saving in economics, what we mean could be some kind of a purchase of a financial asset. So if you buy corporate bonds or you buy shares of stock, we call that saving, not investment. It's anything you try to do with your money other than using it for consumption. So buying a television isn't saving, but buying shares of stock is, in exactly the same way putting your money in the bank is saving. A lot of people, when they think of buying shares of stock or buying corporate bonds or buying government bonds, they tend to call those in the common vernacular investment. In economics, those are not investment. Investment in economics refers specifically to purchases of new physical capital. So we could invest in a factory, building a factory. We could invest in that factory by installing brand new machines, because that increases the total stock of physical capital available. Now, even if our company were to, instead of building a new factory, to buy an existing factory with existing machines from some other company, this would not be investment. That is to say, it would be investment for that firm, but disinvestment for some other firm, and not result in any net investment for our economy as a whole. Note, saving simply involves money, using your money in some way other than consumption. Investment in economics must refer to an investment, a creation of new fixed capital, new physical capital. Now, what we're going to build to try to explain why it is that people decide to save the amount that they save, and why it is that businesses invest the amount that they decide to invest as opposed to some other quantity, we're going to build a model of a market using a supply and demand scenario. And we call this market the market for loanable funds. This is a market for money, but one side of this market is those who would like to save, and the other side of this market is those who would like to borrow. This is the access to financial capital. And we assume that one half of this market, which is a crude representation of our entire financial system, and our true financial system is very complex, involving many intermediaries and many types of institutions. This simple abstract representation assumes that it's households that want to save, and it's businesses that want to borrow in order to invest. So the demand for loanable funds comes from businesses, not households, and it comes from businesses that would like to invest in new fixed capital. So other potential reasons that we think that people might want to borrow money, or that businesses might want to borrow money, don't factor into our model here. We might only say that if there's some other reason that consumers might want to borrow money, we take that away from net saving. We shift in the supply of loanable funds as a result. This model of the market for loanable funds, this supply and demand for money, is something that we can use to help us understand the effect of government policies that affect not a market for goods, but rather affect the financial system, affect the returns to saving, the returns for investment, etc. But this is a very simple and a very abstract model, and it may be less representative even of a true market for loanable funds than supply and demand in the context of goods and services. Because we assume that all savers, anybody who would like to save money, has only one way to save that money. The only way that they can save that money is to save that money in this market for loanable funds. We assume that anyone who would like to borrow money can only borrow money, can only access financial capital from this market for loanable funds. We also assume that there's only one interest rate, not potentially many, so all borrowers pay the same interest rate in exchange for access to those funds. All savers receive the same interest rate, and that the interest rate that savers receive is the same as the interest rate that borrowers pay. Now, if we have many intermediaries in our financial markets, that obviously won't be the case. Bear in mind that this is a simplification, but it still does include most of the important characteristics of our real financial system and what we might think of as a real market for funds, for money. When we talk about the market for loanable funds, the supply for those loanable funds, we say, is chiefly coming from private saving by households. Now, to the extent that we may have public saving, if there's positive public saving, we would say that would simply add to that existing amount of loanable funds that exists, to shift supply a bit out. Now, if governments have negative public saving as opposed to private, we'd say that would take a bit away from the availability of funds supplied onto this market for loanable funds. Now, we would say that our assumption is that households and their private saving might make their decision to save rather than consume, or consume rather than save, partly based on what kind of return they think they can get on money that they save. Now, if they save today, they'll receive more money in the future due to this interest rate and be able to consume more in the future. And the terms of that trade-off between current consumption and future consumption are determined by the rate of return that they could get on these loans, or the rate of return on this interest rate on this money that they put into, supply into the market for loanable funds. Now, in our market for loanable funds, the price that we have in the supply and demand diagram on the vertical axis is either a rate of return on physical capital or an interest rate on a loan. Now, it doesn't fundamentally matter in this case how this interaction between savers and borrowers and investors is organized. It could be through an explicit interest rate, or it could be through some other kind of a contractual relationship whereby that rate of return on those investments undertaken, as in participation banking, ultimately went to the saver. We'll just call this R, where R refers either to an interest rate or to another form of rate of return. Now, here on the horizontal axis, what we have is an amount of loanable funds. Well, we can label this with whatever letter we want. We could call it M, we could call it L, or we could give it a dollar sign. We'll simply give it an L here. And say, as we increase, going horizontally along this horizontal axis, going to the right, we're increasing the amount of loanable funds transaction in the market. And based on the behavior we expect from households in deciding to save rather than consume, we expect a supply curve for loanable funds that follows the law of supply. These households are willing to supply more loanable funds into the market for loanable funds if the rate of return that they would earn is higher. As this point here, on our supply curve for loanable funds, this could go along with a quantity of loanable funds supplied of 40 billion at an interest rate or rate of return of 4%. We'd say that if we want these households in our economy to be willing to supply instead of 40, but now 50 million or billion onto our market for loanable funds, they would only be willing to do this if the rate of return were to rise not 4, but to 6%. We imagine that supply of loanable funds, supply of money, works very much like supply of goods and services, obeys the law of supply. These individuals are willing to supply a greater quantity only at a greater price, where here the price is a rate of return or an interest rate. Next, we imagine that demand in this market for loanable funds comes from businesses that want to invest. Now, I think businesses will be considering whether they want to invest if they see an interest rate of 6% that they must pay out, or whether they want to invest if they see an interest rate of 4%, whether they should or should not demand these funds for the purposes of investment. And we imagine that these businesses have a variety of potential investment opportunities, say opening a new factory, say opening a new restaurant, expanding the size of a restaurant, whatever. They have a variety of different opportunities, some of which they believe will give a return of 8%, some of which they believe will get a return of 6%, some they believe will give a return of 5%. If they see an interest rate of 6%, some of those opportunities for investment are worthwhile, and some of them are not. They would decide not to undertake certain investments because the rate of return necessary would be too high, because the interest rate they would have to pay out to get access to those funds would be too high. So we expect the demand for these loanable funds from businesses that want to invest, likewise, to obey the law of demand. If they have to pay a higher interest rate, some of those potential investment opportunities become not worthwhile anymore, and their quantity demanded of loanable funds with a high interest rate would be low, whereas their quantity demanded for loanable funds with a low interest rate, as some of those investment opportunities now do seem worthwhile, would be higher. So here, we could draw on a demand curve for loanable funds, downward sloping, because it obeys the law of demand. Which would give us in this point a single point, just like in any other supply and demand scenario, where our supply for loanable funds curve intersects our demand for loanable funds curve at one particular interest rate or rate of return. Here an interest rate or rate of return of 5% and a quantity of loanable funds transacted. That's the amount which is saved and also the amount which is borrowed and invested of 45. And if this market is competitive, etc., follows all the same requirements that we have for a perfectly competitive goods and services market, we could say that this market and this equilibrium interest rate or equilibrium rate of return, this equilibrium amount of funds transacted, maximize welfare. Every investment that should be undertaken is undertaken. Every amount of money that should be saved is saved, but money that should not be saved, because it's worth more to the person who could consume than it would be to some business who could invest, isn't. And then what we want to do with this model is to take a look at what the impact of government policies might be that try to incentivize saving. So suppose we impose a government policy to incentivize saving, such as, for example, a reduction on taxes that are charged on interest income, in order to convince people to save more, or changing payroll withholding so that people save for retirement by default. Now, what this would do is to increase the supply of loanable funds. If the government is able to induce people to save more, if we shift out the supply of loanable funds, where that's moving it out and to the right, it looks as though we're moving it down, but that's not a decrease in supply. I mentioned before, it looks like it's going down, but it means a larger quantity of loanable funds are offered into the market at any interest rate or at any rate of return. Now, if this is what happens in the market, we incentivize saving, we increase the supply of loanable funds, and now we increase the quantity of loanable funds transacted in this market from 45 to 50, and we decrease the interest rate or the rate of return from 5% to 4%. So here, giving these incentives to save reduces the interest rate. Giving these incentives to save also increases net investment in our economy because more loanable funds are transacted. On the other hand, if we were to impose incentives not on saving, say a reduction on taxes on interest income, but instead give an incentive to invest, such as a reduction in taxes on capital income, what that would be expected to do is to shift out the demand for loanable funds. If we shift out here the demand for loanable funds, because we increase the incentives to invest rather than save, now we move along this new supply curve. We see a further increase in the amount of loanable funds offered in the market, and the amount of investment, the amount of funds transactions that occur from, say, 50 to 60. And now our interest rate rises back up again from 4% to 5%. So we can see using this model, saving incentives reduce the interest rate in the market for loanable funds. Investment incentives increase the interest rate in the market for loanable funds. But both types of incentives could serve the same policy goal of increasing net investment, therefore increasing capital per worker, therefore increasing economic growth, if that's the mechanism by which the government attempts to stimulate the economy. Well, the next thing that we'd like to do is to analyze a policy scenario which isn't necessarily something that the government is trying to do in order to stimulate the economy, to encourage economic growth, but is something that government is likely to be doing anyway. And that is, what is the effect of government budget deficits? We're assuming that the country is closed. We're not engaging in foreign direct investment in order to get access to capital. So saving is definitely equal to investment. National saving is definitely equal to investment. Governments often do have budget deficits. They would like to spend money on various social programs, etc. But the goal of these budget deficits isn't, generally speaking, to stimulate the economy or to improve investment. Now, we mentioned a few minutes ago that if the government has budget deficits, they have a negative public saving. If public saving is lower, national saving will also be lower. If here national saving is lower, and we haven't factored in the government as a decision maker in our market for loanable funds, we said that that would have to mean that there was less supply of loanable funds available. So government budget deficits, so negative public saving, means there's less saving available in the market for loanable funds. It shifts the supply of loanable funds in. That some of that money that otherwise would be made available to lend out to businesses for investment, some of that money is going to wind up going to the government instead. It doesn't go to the government as taxes. It goes to the government through government bond issues, through government debt. People put their money in the bank, and instead of lending that money out to someone else, that bank will lend the money to the government. Sometimes they're actually required to do so. Sometimes they do so by choice. So what happens in this supply and demand scenario in our market for loanable funds when we shift supply in? Well, when we shift the supply in our market for loanable funds, it has the opposite impact to when we shifted supply out. We shift supply in, we move along the demand curve, and we see that interest rates rise due to that government budget deficit. And we also see that the quantity of transactions that are occurring in this market for loanable funds, which meant total saving and total investment, as national saving, national investment, they're decreasing. So we have less investment and higher interest rates when we have government budget deficits, particularly when we have large government budget deficits, when the ability to invest in our country is limited by national saving because we don't have access to foreign funds through foreign direct investment. If this is the case, that we're not able to invest because that money is reallocated to government borrowing, the term we use to describe this is crowding out. We say the government's interaction in the financial system as a borrower, because the government is so large, is crowding out potential actions of any private borrower who would like to borrow money for investment purposes. So government borrowing is crowding out investment. Now, the United States government, like many or most governments around the world, often runs a government budget deficit. That means in each year, the government tax revenues are less than their spending. And if they have a deficit each and every year, they're not paying off the existing deficit, rather their debt, the accumulated pile of debt, is rising. The US government debt 50 years ago or so was relatively small compared to the size of the US economy, but it has been growing over time. And the same for most countries around the world. There has been a tendency over the past few decades to increasing debt to GDP ratios. So the national debt, the debt of the government, usually to its own people, has been growing more rapidly than the economy is growing. Therefore, in theory, more rapidly than the government's ability to pay that debt has been growing. Now, on the next slide, you can see how the United States specifically has seen the debt to GDP ratio change over time. Now, one thing you'll notice is that that debt to GDP ratio spikes in certain specific cases and then drops down again in a few years. And those cases are major wars. So aside from recent economic history, generally speaking, around the world, the big reason for huge increases in government debt has been the need to pay for an expensive war. And once the war is over, the government has raised taxes to get rid of that debt, pay down that debt. Right now, what we're seeing around the world, the United States and other countries as well, is governments which are spending a lot of money, running large government budget deficits, thereby big increases in their debt, not to pay for expensive wars, but to pay for government fiscal policies during a recession. That is, to try to keep the economy out of recession and keep the economy growing strongly. It yet remains to be seen what the long-run implications of this high and rising debt will be in the United States and in other wealthy countries as well.